This is Module 8C of Accounting 3110 and is actually the third module that is related to process costing. We have focused on the weighted average approach in Modules 8A and 8B, and this module will focus solely on the FIFO approach. Before we move into this new approach to process costing, let's return to the 4 practice questions that were at the conclusion of your lecture notes in the prior module, 8B, and so that I can give you some feedback on these important concepts that we discussed in the prior module. For practice question number 1, when using the weighted average method, is the beginning percentage of completion used in the calculation of equivalent units of production? The answer here when we're using weighted average would be no. We do not use those percentages that are given to us in relation to the beginning inventory because we will be combining the work that was done on the beginning inventory last period with the work done this period. And you will note that when we work on FIFO today, that will be handled quite differently. So even though they give us a percentage of completion of the beginning inventory, that's really irrelevant information if we're using the weighted average approach. The question number 2 says, when the manufacturing of soft drinks involves a bottling department which is followed by a labeling department, the units to account for in step 1 of the second department or the labeling department are best described as. So we're at step 1 and we're looking at what units we have to account for. Typically we would say beginning inventory plus started. But in this case, because our units are not being started in this department, they're actually coming in from the prior bottling department, the appropriate answer here would be to say beginning inventory plus transferred in equals total units to account for. Number 3, when we're dealing with prior department cost, in other words, when units move from bottling to labeling, we have costs associated with those units that are transferred in. And prior department costs are treated just like we treat materials that are added at the beginning of the process. You recall when materials are added at the beginning of a process, they're considered to be 100% complete. This is the way we treat prior department cost in the second department. They are 100% complete in terms of prior department cost. When we talk about the ending inventory and the finished goods for the labeling department, this is question number 4. What are the following 3 cost components? Now, when we have a prior department and we have prior department units and cost, when we go to assign these costs to ending inventory and finished goods, the 3 cost components would be the direct materials, the conversion cost, and now the third item that's added would be the prior department cost. So when we go to step 5 and do these assignments, we're going to have to look at assigning 3 components: the materials, the conversion, and the prior department cost. I see that the next question has to do with spoilage. The cost associated with normal spoilage. This is the kind of spoilage that is expected, that isn't out of the norm or out of the normal range. The cost associated with this normal spoilage would be simply assigned to cost of goods sold, and as you would understand, it would increase your cost of goods sold for the period. If this is an abnormally high amount of spoilage and out of the normal range of what we would expect, we set up a special account called abnormal spoilage expense, and the cost associated with this would be charged to that particular account. Also, when we're dealing with spoiled units, if you look at the next question, when spoiled units are present, the units accounted for in step 1 will include. Now recall in step 1 we say, what units do we have to account for and where did they go? So what we're seeing in this question is, where did they go? They went to ending inventory, transferred out, and to spoiled units. So you would have 3 outcomes here. They either got transferred, they're left, or they were spoiled. Production managers must estimate the percentage completion for these spoiled units, just like they have to estimate the percentage completion for ending inventory. When these spoiled units are present in the final question, cost will be assigned in step 5 to, again, they'll be assigned to transferred out units, to ending inventory units, and to spoiled units. So we will have that third assignment in addition to what we're used to seeing: transferred out, ending inventory, and spoiled units. Let's move now back to the current topic, which is going to be the FIFO approach to process costing. Let's return first to the knowledge you already have about what we mean by FIFO, first in, first out approach. You recall that FIFO does not necessarily reflect the reality of the units, but rather is an assumption. So we can make this assumption, and as long as we consistently make this assumption, then it is valid to use the FIFO approach. Let's talk a little bit in today's module about how this approach differs from the weighted average, why some companies would prefer to use FIFO, and then we will actually look at the mechanics by working an example. So let's talk now about some of the characteristics of the FIFO approach. We can talk about it in terms of its cost or its disadvantages. The biggest cost or disadvantage is that it requires much more complex calculations as we move through the 5 steps. So in essence, it's more difficult to do the calculations. The benefit of the FIFO approach is that it separates the cost and the work associated with the beginning inventory, the work that was done on the beginning inventory last period, from the work and cost associated with the beginning inventory during the current period. Now you recall in the weighted average, it merged the 2 periods in terms of that beginning inventory. We didn't try to see what work was done last period and what work was done on it this period, but the 2 came together through the weighted average approach. So let me say this again. It is the FIFO approach is going to focus on that beginning inventory, and we want to be able to say that this amount of work was done on it last period and this amount was done this period. The cost were the last period's cost, and separate the cost associated with that beginning inventory for the current period. Now the reason some companies will want to choose the FIFO approach is because it really allows managers to know how much it costs to make a product during the current period. There's no overflow or meshing of the 2 periods. They're kept very clean. When we track these costs so accurately and don't let the 2 periods come together or converge, when we do this kind of extra tracking, then of course this allows managers to have a better picture of what is actually going on in each period, and then they're better able to control their cost. Now, in any kind of decision that managers make, they're going to have to look at the cost of FIFO and the benefits and make sure that those benefits exceed the cost of keeping up with such a system. There are 2 types of companies that are very likely to choose FIFO because in their case the benefits will likely outweigh the cost. The first type of company would be a company who has a large or a relatively large number of units in beginning inventory compared to the units that they started that period. So when you look at those two amounts of units, and when that beginning inventory is unusually large compared to the units started, this company, if that's the case on a regular basis, having large amounts of inventory left in the work in process accounts each period, then the FIFO may be the preferred method. Another type of company that may choose FIFO because its benefits outweigh its cost would be a company where there's a lot of volatility. And this volatility could come in two places. It could be a company whose price is very volatile, like, for example, the price of gasoline, the actual price to the customer. The other type of company would be the company who has inputs into their processes, and these inputs, the cost of those inputs are also very dynamic and subject to really quick changes. So when we have either area of volatility in terms of the price or the cost of inputs, companies often will find that FIFO gives them a much better picture of what's actually happening, and they are able to then use that information to make better decisions and control their cost. Now, we have been working on this 5-step system again, looking at physical units, looking at equivalent units, summarizing our cost, calculating our equivalent unit, our cost per equivalent unit, and finally assigning cost in step 5. We've used the same 5-step sequence over and over, and what I want to do now is to go through these 5 steps, very briefly tell you where we're going to see changes when we work our example. In step 1, we have a new situation because when we look at our units accounted for, where did our units go? You'll know that we first have to say how many units do we need to account for, and then I'm talking about that second part which says these are the places where the units are. We have to, when we're using FIFO, we have to know that those items that are transferred out, we'll have to keep track of them in 2 groups. The items transferred out, if you'll recall, when we say FIFO, we're saying that the first amount of work done during the period would be to finish those beginning units, that beginning inventory, finish them, and then start new units. So what we want to understand is when we do step 1, units accounted for, we're going to have to subdivide the transferred out into 2 categories. This would be the units in beginning inventory, and the new category would be called started and completed. So to say it really, really basically, the items that are transferred out this period, the first group that would be transferred out would be those beginning units. The second group that would be transferred out would be those units that were started this period and were 100% completed. Let's look at step 2. For those units that are in beginning inventory, we are told what percent they are complete. We have never done anything with this information because this information, as we said earlier, was irrelevant when you're doing the weighted average approach. But now, under the FIFO approach, these percentages become very relevant. If we are told, for example, that the beginning inventory is 80% complete as to materials, then for step 2, we have to know that we did 20% this month to get the units complete. If the conversion part of the cost or part of the work was, let's say, 40% for the beginning inventory, then we must do 60% of the work this period to get it done. Now what you're seeing on step 2 is a very important point for FIFO. We're looking at only the work that was done this period. So for the beginning inventory, we have to take where it is in terms of its percentage completion when we started the period and compute how much work it takes to go on and finish those units. There is no change in step 3, but in step 4, we are only going to be using current period cost when we calculate cost per equivalent unit. You'll recall, as we just said in step 2, we only care about the work done this current period. So when we look at the cost and where we're headed toward computing cost per equivalent unit, it makes sense that we be consistent and only use current period cost. When you get to step 5, where we assign cost, we have to look at the assignment that will be made to the units that are transferred out. This is probably the biggest complexity in using FIFO, so let me explain this very carefully. The units that were transferred out, and we're addressing how we will assign cost to those units. We really have to think about 3 categories of cost. We're going to have the costs that were associated with that beginning inventory. These costs were incurred last period, but they're associated with the beginning inventory. We have to consider those costs that are already there in beginning inventory. Secondly, we have to consider the cost incurred this period to complete those beginning inventory units. So you had the cost that had already attached to those units, and then in addition, the extra cost this period to get those units finished. And finally, with the third area would be those started and completed units. They were transferred out as well, and they all the work for those were done this period. They were started and completed within the current period. So I think probably at this point the best thing to do is for you to look through your lecture notes, look through the data that's going to be associated with our FIFO example. I'm going to work it through with you step by step, and you can note that when you go on the D2L site in the content area for Module 8C, that you will find an Excel template if you'd like to look at that. It's important that we don't get dependent on using these templates in computations of these problems, but I think it is good to see it all on one page and see how this template would look if we were using the FIFO approach. Let's start to work on our example. Again, the data is in your lecture notes for 8C, but when we start in step 1, we're looking at physical flow of units, and in this problem we had 2,000 units in beginning inventory. We started 12, so we're going to have to account for 14,000 units. Now if you look at the categories here in the second part, which tells us what happened to these units, where did they go, what we're going to have to do, as I mentioned earlier, for the transferred out, we're going to have to look at 2 categories. We're going to be transferring out the beginning inventory, and we're going to be transferring out the units that were started and completed. If we look, the beginning inventory has already been given to us. The problem gives us 4,000 ending inventory, and we know that the total must equal the total units to account for, so it is very easy for us to find started and completed. Okay, now let's talk about the physical flow. What has happened to these units? We've transferred out, I guess, 10,000 units. The first 2,000 to be transferred were the beginning inventory units. Then we started 8 and completed 8,000 more units and transferred those. But let's go up here to the started and make sure this makes sense to you. We started 12,000 units. 8,000 of those were finished and sent out of the department but 4,000 remain in ending inventory. Let's continue, and what we're doing, as you can see in my notes, in step 2, we're going to be computing equivalent units. And it says right here, work done this period. So we only want to compute the equivalent units for work we did this period. So let's take a look at the first category, the beginning inventory. According to your lecture notes, the beginning inventory was 40% complete as to materials. But the 40% of the work was done last period. What I want to know is what percent was done this period. So this becomes 60%. 40 plus 60 equals 100. In terms of conversion costs, the problem says the beginning inventory was 80% done. So in this case, if it's 80% done when I start the period and I finish it this period, I must be doing 20% of the work this period. So if we do the calculation, this becomes 1,200, this becomes 400 EQUs. Again, I'm taking the percentage that they give me that tells me that beginning inventory had X amount or X percent of work done last period, and I'm finding how much work had to be done to get the units completed and transferred out this period. Started and completed, we understand that 100% of the work was done this period because we started it and we finished them. Now the ending inventory is as before. The management would have to tell us the degree of completion here, and they said 25% materials, 60% for conversion cost, and we can compute our equivalent units. So this becomes 10,200 for materials, becomes 10,800 for conversion cost. So these numbers here, 10,200 or 10,800, this represents the amount of work done this period. And as you can see, we worked on 3 different inventory components, but working on those 3 components is the same as producing 10,200 equivalent units or whole units in terms of direct materials. Let's go on to step 3, which we said there's really no change. All we have to do is include the costs that were in the beginning inventory, 2,000, 1,000, total of 3,000 for beginning. Our current period costs for the materials were 20 and 7 for conversion. And we can find the total cost. So nothing new there. We are going to summarize these costs because you will recall when we finish step 5, we're going to want to be able to make sure that once we assign costs that they all add back to the total, which would be 30,000. Now let's look in step 4, and this is extremely important. We will only take the cost of the current period for use in computing the cost per equivalent unit. So only current period, because the work, the equivalent units represented only the current period. So we need to be consistent between the cost and these EQUs that we will bring in from step 2. So we will get 1.9608 for the cost per equivalent unit for materials. For conversion, we will get close to 65 cents, and then we will total for all the cost would be 2.6089. So we have a cost per equivalent unit that was computed using only the work done this period and only the cost that were incurred this period. As we discussed earlier, the most complex part of FIFO comes in step 5, and we need to say this again. We are still just assigning costs to the units transferred out and then to ending inventory. So don't lose sight of the big picture. We're still taking the cost and trying to assign them to 2 places. The ending inventory, there is really no change in how we do that. We have to look up to step 2 and get our equivalent units. But there is going to be a change in the transferred out because we have 3 cost areas. We have to look at those costs that were already associated with the beginning inventory. We showed those costs in step 3. That it was $2,000, $1,000, and $3,000. And we must go ahead and assign those costs, the $2,000 plus $1,000, and we're going to go ahead and assign those to the units transferred out. Secondly, we're going to return to step 2, and we're going to find our EQUs that are related to the beginning inventory. This would be the 60%, the 1,200, and the 400. And then we simply going to use our cost per equivalent unit that we computed in the prior step. The 400 units had to do with conversion. And we will calculate these 2 numbers. And we will get 2353. And when we take the conversion, EQUs times the cost per equivalent unit, we get 259. All right, so what we're saying at this point, the transferred out units contain the costs that were in the beginning inventory because those units are gone and the costs go with them. These are the costs associated with completing those beginning units and getting them all the way ready to transfer out. And then, of course, we're going to have the started and completed units from step 2, which, of course, were the 8,000, and they were obviously 100%. So we can just take the 8,000 and use the full cost here for both materials and conversion. All right, 8,000 units times the 2.6089, and we will get for that 20,871. Now here are the 3 costs associated with transferred out. Those units that were started and completed, the beginning inventory, the attached costs that we started with this period, plus the cost of finishing those beginning inventory units. And when we total up all of this, we have found our cost to be assigned to units transferred out. Ending inventory, let's go back and look at our equivalent units. We had 1,000 and 2,400, and there's nothing new here. We just have to multiply by the appropriate cost. All right, so when we look at this and do our calculation, 1961, we will also get 1556, and we will get 3517. And this is a classic example of when we have any rounding at all, the numbers are not going to tie back perfectly. let me go back and show you that this is the number we're trying to tie to the 30,000. So the combination of cost transferred out and cost left in ending inventory should actually add perfectly back to 30,000. In this case, we have a rounding issue here, 30,001. So this is not a serious problem and something that we shouldn't waste a lot of time on, because when we do any rounding, it's very possible that we're going to be a few dollars off. So again, please don't waste a lot of your time worrying about that. But let's look at what we've got here. To conclude this problem, we had $3,000 in beginning inventory, and then we added in $27,000 of cost this current period. We ended up assigning $26,484 to transferred out, and we ended up assigning, let's just round it here back to 3,516, so it will work out nicely. Our $30,000 has been assigned between transferred out and ending inventory. As you work on these FIFO problems in your homework, I would highly recommend that you go back to the portion of this video, the portion of your lecture notes that talks about how FIFO is different at each step in the 5-step sequence. I think that's the easiest way to see how very different the approach is than when we use the weighted average approach in the first 2 modules related to process costing. Well, this module concludes our study of process costing. It's a very detailed area of study. It's very important, now that we're finished, to reflect on a couple of really big issues. And the first thing that you must understand is what types of companies would appropriately use process costing instead of job order costing. These companies, you must remember that we're making something, that we're making it in a continuous flow, that every unit looks the same. We would call this homogeneous. We would call these homogeneous units, and we can't tell one unit from the next. What we do is we accumulate the cost by the process or the department, and then we assign the cost to the units that actually pass through that department. The costs end up either going to the units transferred out or to the units that are left in ending inventory. And just a quick reminder that some companies do keep track of spoiled units, and if they do compute or assign cost to the spoilage, then the step 5 would always include the assignment of cost to transferred out, ending inventory, and spoiled goods.